Thank you, Cindy. Going to get started here. Delighted to have John Mayfield with us today. John is founder of Album VC, which is based outside of Salt Lake City in Lehi, Utah. And it's particularly timing. The timing is particularly good because John and his firm recently led an equity investment in Liberty Lake-based Vega Cloud, which was founded by Chris Bleasner, who I know a lot of people are familiar with. Chris has been a successful serial entrepreneur in the Spokane area for a number of years. John and Album's investment was part of a total $9 million equity and debt financing. Some of the other equity investors included members of the Spokane Angel Alliance and My Angel Fund Kickstart. The debt was provided by Sun Mountain Capital, which is managed by Kevin Barber, who lives in Seattle, but was actually born and raised here in Spokane. And I know a number of people on the call here know Kevin. The purpose of Meet the Investor is to introduce regional entrepreneurs and others to angel investors and VC funds and PE firms from outside the area. And it also provides an opportunity for those providers of capital like John to become better acquainted with startups and emerging companies in our region. So it achieves a couple of different objectives. Meet the Investor is sponsored by Witherspoon Kelly, which is one of Spokane's largest law firms and has a specific focus on advising on fundraisings and M&A transactions. Rick Rupp, who is a partner with the firm and very involved with Ignite and the Spokane Angel Alliance, and also who focuses exclusively on serving entrepreneurs and emerging companies and investors. Unfortunately, couldn't be on the call today, but he's typically here to introduce our speaker. The format today, I've got a list of questions, which I will cover with John, but I really aspire to make this interactive. So if you have a question, please present it to me in the chat box and I will call on you. So with that, we'll go ahead and get started. And I really kind of like to kick things off with really kind of getting a sense for your background, John. So maybe if you can kind of just give us a Cliff Notes or high-level version of what you did prior to co-founding Album in 2014.
Yeah, so I'm born and raised here in Utah. Family grew up here, and so I have ties here. I graduated from college. I went to BYU, which we were talking before the call got started. Has a mediocre basketball team that gets beat often by Gonzaga, but
not mediocre.
Yeah. The fans always think this is the year, but it never is. It's one of those types of teams. Hopefully this year, though. Hopefully a good team. Anyway, so did BYU, moved out to the Bay Area. I was out there for a number of years doing M&A transaction work, working on the valuation of companies that were getting acquired. So generally working on the acquirer side. So HP, Oracle, Yahoo, Cisco, the big acquirers, 15 years ago, they still are, but we worked on their transactions and then occasionally work for a private company, 409A valuations and things of that sort. And so did that for a number of years before actually moving back here for an opportunity and joined a venture fund up the road here, which is still in existence, Peterson Ventures, and a great fund. They were just getting started raising new capital. It was a kind of a family office turned venture fund. And that's really where I got my first taste of doing venture deals, getting out there and sourcing deals, learning how fundraising works, both from an entrepreneur side, but also a GP side, and basically building a network for sourcing deals. And so from there, though, I joined a startup called Qualtrics, which was started out of BYU. It was started by a professor there who had a son who was pretty entrepreneurial, who took it from a family business, kind of bootstrapped story to a venture-backed high-growth company to a unicorn to now a publicly traded company. So Qualtrics raised a Series A about 10 years ago or so, from Excel and Sequoia, and I joined Qualtrics at that time.
Okay.
Rode that story for a couple of years before jumping off and doing what I'm doing now. So we started with a very small venture fund. Our first fund was $22 million, and we invested in 31 companies actually. So it was a very different strategy than what we have now. But that's really my background. And so the last 8 years has been doing this. And so, this is kind of the most modern history, recent thing I've been doing for quite a while now.
Okay. So you've got a well-rounded background of experiences and skills to bring to bear to being a venture investor. I mean, it's I used to have a venture fund and worked with a lot of VCs, and it's really value added to have someone that's been an operator and is kind of seen investing and emerging growth from a lot of different perspectives. So that's differentiated. But what kind of inspired you to go off and start your own fund?
So the way it happened was Utah, much like Spokane, and it's kind of a little bit smaller scene, certainly nowhere near where the Bay Area is. But there have been great companies that have come out of this ecosystem, and it was becoming more consistently great companies coming out of Utah. Utah actually has a long history of engineers, like specifically software engineers. There's a lot of biotech and pharma here as well, of which we don't do that, but had some big successes in the state. And then, was actually one of the original nodes of the internet when it was back, a government and ARPANET up at University of Utah. And so there's just been a lot of interesting people that have deep developer backgrounds. And, Utah has grown to a stage where there's been a lot of people that have gone to the Bay Area or gone to New York or even global, and now are coming back here. And so there's just a lot of talent that wants to be here. I think that's probably true of like an area like Spokane too. Highly talented people, they go out and they come back and they want to raise a family there, or they just like the lifestyle a little better. And so what we saw was there's a lot of great companies being built, but the ones that did emerge and became elite companies and got purchased for, 9 figures or went public, they didn't have any early stage capital. They would have to raise from, the doctors, dentists, and family kind of thing, right? It's a little bit unsophisticated is probably the wrong word, but folks that are not always in the market and are a little bit inconsistent in their check writing abilities. And so we wanted to be that player, and so that's really where we started. And it was say, hey, we're going to be that first institutional money in, and that's how we got started. And we actually had our anchor LP. So I had mentioned we raised $22 million. We had an anchor LP that had invested in a bunch of real estate projects, and some of those had been in Utah. And they saw some of the activity going on in Utah and on the venture space, and said, hey, we'd like to invest in some of that activity. And so rather than do an SPV and do a kind of one-off deals, they committed to half the fund. And so they were 10 million of the 22. And that's actually a Swiss Brazilian family office of all places. So you probably ask, what's the connection? Well, there was one of the high net worth individuals who was an investor in that multifamily office, had a son who went to BYU, and that son at BYU was an intern at this real estate outfit that was investing in Utah. So it's kind of this really interesting circuitous introduction to Utah. So now they're some of our best friends, and they've been in every fund and have been some of our long-standing supporters. So they've invested in every fund up to this day. So yeah, that's how we got started. And it was pretty humble beginnings, and I would say early on it was more of an experiment than it was kind of a true vision for, hey, we're gonna do this for 10 years. It was more, hey, there's an opportunity here, and let's go see if we can find some great companies and kind of do venture a little bit different. Because I think sometimes when there's a lot of entrepreneurs but not enough capital, bad behavior emerges, which the capital, puts weird terms in, or
Yeah.
is debt-like, or, kind of jerks entrepreneurs around or treats them wrong. And so I think, we brought an approach that was very deliberately trying not to be that and trying to be fair and bringing a little more of a modern Bay Area approach to let's maximize upside. Let's not worry as much about downside, right? That's venture. And so I think that's really resonated with entrepreneurs and brought a new take to the Utah scene, at least. So yeah, that's our start.
Excellent. Well, I can certainly relate based on some of the things that we're doing here in Spokane, and frankly, I kind of have Utah envy. The community has really done a great job of building a vibrant entrepreneurial ecosystem in Salt Lake and the surrounding area. So is there a story behind the name Album? Where did that come from? Are you?
Yes, we had another name before, which you can look up. We were known as Peak Ventures before, and we're here in the mountains, and the name didn't really mean much other than it was a little bit cliche. I think if you look at the history of venture funds, or the names have evolved over time. It used to be the last names of partners, and then it was kind of like the street they were on, or then it became, some geological feature. And now we're kind of in a new wave of naming nomenclature for venture funds, and it's just a random name. But we had a branding firm help us out, and we went through dozens of names. But Album was one of the first to be thrown out after going through an exercise of saying, who are we? What do we want to be? And what are we to, what is our place in the world? And, we all like music. Sadly, none of us are overly gifted in music. And we're not, we do not have a band on the side or anything like that. But Album is a nod to the creators in the music industry, that it's generally really small, eclectic teams that are highly skilled in their own ways, a little bit off the beaten path sometimes, have a different view of the world, are trying to push their creative boundaries and do their best work. And that's what we're trying to find is people who are similar to, what a band would be, generally starts very grassroots in a garage or in a basement or a spare bedroom. And we want to be, some of the fuel behind that band to get them, out in the world. And so it's that, but it's also, an album is also it can be a collection of pictures or, kind of something memorable. That is what we're trying to be at Album is try to bring a unique take and try to bring your best to every experience. And so create a collection or an album of experiences for the people that we interact with. And so that's how the name emerged. And we've been with this name for a little over 3 years now. We rebranded with Fund 3. And, I think it just is something we're proud of, something we're trying to, infuse meaning with, and, just kind of remind us to always bring our best and to always be reminded that great things always start small. And sometimes the best things start with, not the most well-rounded people, but pointy personalities, people who have a unique take and are, kind of, you have to squint or kind of scratch your head once in a while and always kind of retain that curiosity and, what could this become? Not what's right in front of your face, because maybe I'm going on too long, but sometimes in venture, you don't want to always just invest in the most obvious stuff. Right. It's kind of, you want to invest in markets that might look a little small or been overlooked or that are tired. And, but, in reality, if you dig a level or two deeper, there's a lot there, or the market is going to expand into something beautiful. And also the entrepreneur can often be a kind of a non-consensus entrepreneur. I think a good example of this that was very public, and who knows how this will play out, but WeWork was a pretty epic flame out, and there was a very controversial recent funding of Adam Newman by A16Z. I think that was a great kind of example of this, like where nobody else would have touched him, but A16Z, who I have a lot of respect for, kind of said, hey, we see something else, and this guy has learned some lessons, or he's putting skin in the game, or he re-envisioned office, now he's going to re-envision housing. So it's kind of that. So yeah, that's what Album is, and as you can tell, we're pretty passionate about it, and it's been a good new brand for us.
Good. Well, tell me about your team. Who are some of your other partners? And, it appears for a fund your size, you've got a relatively small team, and kind of wondering, is that by design, or what? How did that come about?
That's a great question. So yes, we have a very small team. There's 6 of us total here full time. Sometimes we have an intern or 2, but sometimes not, like right now. Anyway, we've got three general partners, myself, we've got Sid Cromanhook and Diogo Mija. And so we came together in kind of an interesting way. Oftentimes venture funds come together because they, were both at Battery Ventures or Sequoia or something like that, and they spun out. Ours was much more humble, I would say, and we like to say, much more Darwinian. It kind of like, it just happened, we were brought together in what we now view as very fortuitous circumstances. We have very different styles. I come from more, I'm not an entrepreneur. I shared my background. Oftentimes VCs are. I don't consider myself an entrepreneur, but my 2 partners are. So Sid has started 4 businesses. Diogo started 2 different businesses. And so, and we all come from different backgrounds. I grew up here in Utah. Diogo is actually from Brazil and made it here to Utah. His family sent, he came to BYU. And then Sid is half Dutch, half Mexican, born in LA. And then, actually did grow up here. His family ended up moving here. But anyway, so we are a little bit unique in that, none of us went to an Ivy League school. None of us worked at Google or anything like that, or any like the top tier VC funds. But we have like a different style that seems to work, a little bit complementary. We've kind of got, I'm a little more buttoned up. Sid, I would say, is like more the passion, and Diogo's the hustle, the hustle. And so that's how we came together. That's us. As far as the number, yeah, we take cues a little bit from a few venture funds that we really admire. In particular, we like Benchmark a lot. Benchmark Capital, I think, has really, they've kept a fairly low profile for how just amazing they are.
Yeah.
In the LP circles and GP circles, I think Benchmark would always be in the top 3 of who's most respected in early stage venture. And I think part of that is because they have an equal partnership, and because this is they keep their funds small, and they're a little more concentrated in their bets. Mm-hmm. And I think they take risks and attract entrepreneurs that others don't. And so that's kind of what we're trying to be. Okay. In venture, I guess I'll start in private equity. In private equity, a little bit later stage, you sometimes see the firms be a little bit more pyramidal. They have kind of a few people at the top, and then they kind of, build analyst classes and managers below. And a lot of the real work and sourcing is being done at the lowest kind of rung of the pyramid and working its way up. Mm-hmm. In venture, we think it's more of a flipped pyramid, actually. You kind of have a few people at top and then a couple support staff. Yeah. Because we don't think the best way to do venture is to outsource your work. It's not about, honestly, like who can source the best deal or who can do the best analysis. It's almost like who can get into the best deals. And so, yes, you gotta have a network and you gotta source, but a lot of times you're looking for different signals than just checking the checkmark boxes, like for revenue and, market size and, did the team have strong resumes? We're really looking for more intangible things. And so that's why we've kept our team really small, because the bigger you grow your team, well, first, more management problems, and more just kind of like worrying about building your team and not worrying about sourcing deals and working with your companies. And I guess second is we don't want to have that temptation of pushing the work to other people. You kind of have to do your own work here. And so
Yep.
that's why we've done it this way, and it seems to have worked so far.
Okay. And I think if I understand correctly, you talked about your first fund, and I think you said it was 22 million and you made 31 investments, which is quite a few. And if I understand correctly, you guys are a bit more focused right now. You're not spraying and praying, but you're being more selective. And I think I read that really each partner only takes on a couple of new deals a year.
That's right.
Could you elaborate on that a little bit?
Yeah. So I think there's two questions to be answered here. I think in the early days, we were, a little more, kind of viewing this as we just want to get in great deals, without regard to as much, ownership structure or, our involvement going forward. Are we on the board or not? How much can we help them? I guess we weren't thinking about those types of things. And so I would say now we're highly interested in those things. Like, how much are we helping our portfolio? Like, are we spread too thin? Are we on 15 boards, 20 boards each? Like, that's just not a good recipe in our opinions for giving founders a great experience. And so we've really trimmed down what we do. And so starting in fund 2, we kind of learned, if you're going to make real money in venture, you want to own a lot, and you want your founders to really love you, because you want to have pro rata rights. As much as the docs say, like, you have pro rata, it generally really comes down to the founder's preference. Like, who do they want to, who investors have helped, which investors have helped them the most, and who they love. And so we've really skewed towards that. And so now we're doing 20 deals per fund. And we've been very disciplined in not deploying a fund in a year or two. Like, it really takes us about 3 years to deploy a fund, sometimes a little over that. And so that really equates to about 2 to 2.5 deals per partner per year. And that's a good cadence for us, because, we see a lot of deals. And if you're only doing 2 deals a year, it does raise the bar, for who gets money, which is unfortunate. We have to say no more. We really hate that part of it. But for the ones we do, I think it's better for us and a lot better for the entrepreneur, because it means that we have that much more conviction and also that much more time for them. And so that's how we think about it. We think it's a trade-off worth making. And so that's how we're set up. I should also mention, we are a seed investor. And so we don't have to stay on the board until it gets sold or goes public. We really view our job as kind of a sprint. We have a couple classifications for how we think about our involvement in a company. And, we're happy to take calls from founders who need help, even if they're, podium size. But the truth is, we're not going to be the lead investor. We're not going to be probably the most, useful board member there anymore. Excuse me. And so we're like in a sprint on a company for about 2 years. And so that's where we're highly involved. And our main job is to, kind of help set up some of the structure of the company. That's legal docs, that's kind of governance, things like that. Just the hygiene of the company to make sure there's accountability built in. 2, help them bring in great talent. And so the first usually 20 or 25 hires after we come in are what we think is the most critical hires, just to set the path and the DNA of the company. And so that's the second. And usually that's helping recruit like a senior hire, helping them think through their headcount planning, their culture, things like that. And then the third is just helping them raise a good Series A or Series B. So we have cultivated a lot of relationships with, the best funds in the world who are highly interested in a growing company. And so, we're not going to be able to capitalize the company forever. And we know that, the founders know that. And so, but we can be very useful in culling the list, making it easier to raise a Series A, and, hopefully not spinning as many wheels, just talking with everybody. We help curate the list, do some back channeling, and help make those introductions so things go a little bit faster. Also contributing to the Series A or B in a pro rata or whatever fashion works, because that's also a big thing. Next investors often like to see participation from the existing investors. So yeah, that's how we think of our
Okay.
role.
Okay.
Yeah.
We probably got to step back here. Why don't you summarize, your investment focus or criteria in terms of industry, stage, geography, and those sort of components?
Yeah. So we started in Utah. The founding thesis was Utah has great companies and they don't have enough local early stage capital in them. So that's where it started. And so I would say we've broadened quite a bit since then. Utah and the Mountain West area are still a big part of our thesis. In fact, of our investments, about 2/3 is in this region. But as we've grown, our networks have grown as well. The way I got involved with Vega, for instance, I am on the board with someone who is on the board at Vega, Bob DeSantis. And in the course of my board work on another company, he's like, hey, you really ought to check out this other board I'm part of. He's introduced me to a couple, but he, in particular, he said, really like this founder, really well-run company, kind of small, but poised for a big year. And so that's how we got introduced. And the reason I mention that is that's very common. So the way we like to say is in Utah, we're very proactive. We want to turn every stone and meet virtually every company that kind of, venture that could be a venture-backed company here in Utah. So we're very proactive. Outside, we're very reactive, and we rely on a lot of signal. And so it's got to come through a warm introduction, really.
Yeah.
So that's the way we get introduced to companies. But to get a little more specific on what types of companies, we are generalists, but there's a lot of stuff we don't do, and that's probably a good place to start. Biotech, pharma, med device, not our thing. We've even added, you brought up Owlet at one point in this conversation. I think it was before we really got started, but we loved Owlet, great company, good success, but we don't really do consumer goods anymore. We've just found we don't know them that well. We're just not specialists there, so we're not really doing that anymore. But what we are doing, enterprise software. So anything that has to do with a B2B sale, and at the software component, tech enabled, but also pure SaaS. We like that. That's a good place for us to be, and I think we've proven we understand it, and we have good networks there. Second, we like marketplaces. We like marketplaces because there's a lot of areas in this world that still have fat and happy middlemen, or are just not quite efficient enough because it's just the way they've always been done. And so we just think there's a lot of areas that can be improved by having some piece of software or some more modern marketplace involved. And I think you also get the added benefit of a marketplace. You get network effects. They can be very defensible if you get to a certain scale. And so as in most venture businesses, you're looking for high margin, highly defensible businesses that can scale fast. And so marketplaces fit that. Within enterprise software, but I think it's worth shouting out, is we have developed interest and some expertise in fintech. Just anything involved with financial transactions, could be payments, could be neobanks, just all those types of things. We think the whole financial system is being reinvented for the better in many ways. So that's an area of interest. But yeah, we're very curious people, and I would say we look at anything really that kind of falls generally within that purview.
Okay, and then in terms of stage, your seed, early stage.
Yeah, so seed and Series A classic is how I would say. And what is Series A classic? 10 years ago, 8 years ago, it used to be a $4 million or $5 million round could be called a Series A. It's a little bit of traction, $500,000 to $1.5 million in ARR. That was a Series A at that point. We're doing those. We're also doing a little bit of pre-seed, all the way down to pre-seed, I should say. But the pre-seed stuff we do is almost always people we've known or operated with the past, or people that have been in our portfolio that we've kind of watched operate. And so, yeah, pre-seed to very early Series A is how I'd say. and it's almost always rounds between $1 to $5 million raises
Okay.
of equity. And, we're contributing $500,000 up to about $4 million
Okay.
of that round. Yep.
In terms of fintech, has anybody introduced you to Treasury 4 here in Spokane?
No,
Okay,
I don't.
well, I will. It's a fintech company here in Spokane, early stage, and I will follow up with you offline on that one.
Great, thanks.
Really a great team and a compelling opportunity. No, I might just pause right here. I've kind of been doing all the questioning and see if by chance anybody else on the phone here or on the call would like to ask a question or encourage you to do so. Well,
Yeah,
hearing none, but if you, oh, yeah, Sam, do you have one?
Yeah, I do. I'd like to have you maybe double click on the marketplace when you said, that was interesting, your comment around a fat middleman. I mean, and the different personas that you may serve in the marketplace to really get out there and scale. But your definition of what you mean by that would be really helpful.
Yeah, I think they can come. Marketplaces can come in a lot of different varieties, but generally a marketplace is entering, when there's some kind of inefficiency or it's it's kind of always the way it's been. And so that's generally what we see out there in the market. Marketplaces are usually reinventing some segment of an industry or an industry altogether. But yeah, I think we're looking for things that can add more efficiencies, and it has to, there's kind of there's a lot of checklists out there, but it kind of has to, reduce costs, or it has to increase speed, like quality, reliability, and cost. I would say is kind of the three that come to my mind most readily. And you'd hope to be, kind of causing a large step function improvement in one or more of those metrics. There are more metrics, but those are kind of the three that come to mind most readily. And so, you don't have to have like a defined, fat middleman, but oftentimes that's what you do find in these kind of things.
Okay. Thank you.
Thanks, Sam. So assuming a company kind of fits it's within your geography, it fits your industry focus, it's at the right stage, what are some of the other key variables or factors that you're looking for in the companies that you back?
This is a great question. So early on in our evolution, we used to have a lot more of like a checklist. It was kind of like, hey, you're doing the diligence and all these things, what you might you expect out of an investment firm. And we still have that to a certain degree, right? But I will say we've distilled it, and it's become a lot easier. Easier is the wrong word, simpler. I'm looking for why this person, why this opportunity, why now, at the very highest level. And so this, I think Vega is probably a good example of this. Chris has spent a pretty major part of his life. For those who don't know, he's in cloud optimization and this emerging trend of FinOps, which is kind of the financial optimization of cloud spend. And so a guy like him, he had a highly successful company in Second Watch. By all measures, it was very good for almost everybody involved. He still has kind of unfinished business, I would say, and that's something we like. And so why him? Unfinished business, has a little bit of chip on his shoulder to go create something large, prove any naysayers wrong, and he's very highly qualified. He knows what he's talking about. He's surrounded himself with a team and a board who really understands the space. And so what is the space? Why now for the space? I mean, this space, everybody rushed to go into the cloud over the last 10 to 15 years. Not everybody optimized or got deployed in the cloud correctly. It was just kind of like, hey, rip and replace, like, kind of copy paste over here. And it was just like, okay. And at the same time, all these different clouds have emerged, and they all have different cost structures and different costs and benefits. And so that's the why this opportunity for him is he's been doing it for a long time, but why now? Because it's like, it is time for the cloud, not just for companies to be in the cloud, but to be optimized. So that, I would say, at the highest level is what we're looking for. This might sound a little weird, but we like founders that are a little that have pointy personalities in certain ways. They don't have to be Elon Musk, who's in the news every day for saying something a little bit controversial, but it's like you need somebody that has a unique take on the world, that probably has some extreme strengths and some extreme weaknesses that come with it, but yet they are able to build a team around them and tell a compelling story. So we're looking for that. So just to expound on that storytelling, I think a lot of the best entrepreneurs are great storytellers. And so I think that's also what we look for. That's important because we don't view our job as like, hey, come into Album, we'll teach you what to do, and we're going to do a lot of work for you. Like, although we try to do a lot of work, like the truth is the entrepreneur and their company was already probably destined for greatness, but we're going to help, hopefully make fewer mistakes and make it go quicker and make a few key introductions and just kind of optimize around the edges. And so that's what we're looking for, is like a founder that just has that energy, ambition level, and kind of a unique secret for a market.
Yeah.
Yeah.
Very insightful. Love the answer to that question. How would you describe, if I'm, okay, let's say I'm a founder in a company that meets your criteria and I've got a hot deal, I'm oversubscribed. How do you differentiate yourself and convince me, for example, that Album and you or your partners ought to be included as a lead investor or in the syndicate? How do you differentiate yourselves?
Yeah. So I'll start that question off by saying that does happen sometimes, but I would say that's more the exception than the rule.
Okay.
If a company is hot at our stage, like it almost is never the right company for us. Sounds a little paradoxical.
Yeah. Yeah.
We're trying to find stuff that's a little non-consensus. So we try to find stuff that, maybe, has been overlooked, or, we get to it a little earlier, or, so we're trying to find stuff that we have conviction, and, we look stupid today, but hopefully pretty quickly smart.
Okay.
But with that said, I'll answer the question more directly, because that does happen sometimes. Like the best entrepreneurs.
Okay. But that is part of your diversity, how you're diversified.
That is part of our diversity.
Like you said, these grassroots bands that haven't been discovered yet.
Exactly.
Okay.
Thank you for using that analogy. Yes. So that is the truth. We do want to find more of the grassroots bands that haven't been discovered, that have raw talent and are kind of going for greatness. But I will say sometimes it is like an entrepreneur who has a lot of options and, who ran a really smart process and just got a lot of interest. And the truth is it's, capitalism. So they want to go with the highest price and blah, blah, blah. We are not often the highest price, but I think we're very fair on our terms. So clean terms, I will say, is one way we differentiate. We do preferred rounds, but I would say our terms are quite entrepreneurial friendly. We use the NVCA docs light, I'll call them like a NVCA light docs. And I think we want to set the company up for some governance, but not a lot of control from the preferred investors in the board. And then second, we actually let the way we get introduced to deals, usually by the nature of how we got introduced, gives us somewhat of an advantage and kind of a line to the entrepreneur. So we're not doing a lot of like shopped or baked, it's not like a bake-off type of process. Usually. They usually come from a very warm intro. And so the follow-up to that is a lot of times we are having that person who introduced us, go to bat for us. And then a second level of offense is oftentimes we'll say, hey, the proof is in the pudding. You need to talk to our founders. And so we'll give them a list and say, here's the list. Which founders you want to talk with? Just point to the ones you want to talk with and we'll put you introduce you to them. And so we do that. And sometimes they point to the great ones because those are the ones they know. Sometimes they point to the ones they're like, I've never heard of that because it did not work out. And so, and that's great because we think, the body of a VC's work should include all of the work. And so we have, and we do win deals often on that as well, because we've been, through good and bad, I think, we've proven ourselves to be pretty good partners. And that's not just us saying it, that's our founders. And so that's one other way we differentiate.
Okay.
Yeah, I'd say those are kind of the main ways. Yeah.
And I think if I read somewhere that in your latest fund, you've got representatives from 35 of your previous investors. So founders of 35 other companies or management team members are part of your current fund, which, speaks very highly. I mean, they've worked with you once before, and now they're kind of stepping up to invest with you. And that's a strong signal.
Yep. So just to expound on that, so by count, our entrepreneurs are our largest LPs by number of folks. In Fund 3 and Fund 4, we've had the benefit of bringing on some great institutional investors who write large checks. So by dollars, those institutions make up about 85 to 90% of our capital.
Yeah.
So the founders don't make up a lot of the money, but they do make up anywhere from $50,000 to probably about $500,000 individual checks in our funds from those 35. And so that was just a piece we wanted to, have in this fund. And it was very deliberate because we didn't have that in Fund 1 and Fund 2. In Fund 3, we started it, but didn't really say anything about it. It was like, kind of small. Fund 3, we gave most of our founders an opportunity to invest in the fund in a very tactful way. We didn't want them to feel, hey, we invest in you, you got to invest in us. It was like, zero pressure. Don't want you to make you feel like you have to invest. But if you do, we have this little founder sleeve that we've carved out. Any amount, come on in. So we were delighted when, 35 founders of ours, stepped up and raised their hands. So that's a nice
great source of warm introductions.
Yes, that is, you haven't asked that question yet, but that is where a lot of our deal flow comes from, is just our founders, other founders, and just frankly, other people in the community. We try to be involved with the community, network a lot. And, there's a lot of people, that was a VP of sales over here, becomes a CR over there. And they've got, one of their friends starting a business. So that's very common, is how we get introduced to companies. And so, we try to have this very, kind of very inclusive brand and community, around our companies and our firm. So that's the best.
You have a pretty compelling track record. I think I also read, have you backed all 7 of Utah's 7 unicorns or something along those lines?
So we started in 2014. Unfortunately, there are a few that started before we got started that have become unicorns. I mean, unfortunately for them, but we wish we would have been in those ones too. But yeah, of the software companies that have gotten started in Utah while we've been in existence, we've been, let's just be honest, like hard work, great, good brand, great. We've been a little lucky too, but I think, we've hustled and got in some of the best deals, and all credit goes to our entrepreneurs. Like, we played a small part, but yes, that is true. We've had a pretty good, batting average of getting in the best companies here in Utah. Now that's not possible forever, but we've had a good streak for the last years.
That's amazing. You talked about how you invest in company favorable preferred stock terms. Does that mean that you invest in safes or convertible notes as well as a initial investment? I mean, presumably you may do convertible notes as part of a bridge loan, but so many companies now are kind of going out and their first round of capital is a convertible note or a safe, and just kind of wondered what your commentary is on that.
Yes, we do invest in safes and convertible notes once in a while. I would say we have a preference for preferred rounds. If it's a very small pre-seed round and it's really just about, hey, getting off the ground, it's a smaller amount of capital, under $1 million, maybe under 2. A safe can work. But we're going to probably have the conversation about a cap as well. We don't do a lot of uncapped, no discount stuff. And that's just like, hey, we'd rather just wait and see if we can get in the next round. That's awesome. More power to entrepreneurs if they can get those terms and do that. But, we just feel like our role in the ecosystem and in kind of helping a company, a preferred round is actually part of that. It's getting kind of all their docs in order, kind of legal, their legal house in order. And it's a good opportunity, and it's not fully altruistic, but we want good, clean terms, because the truth is, like, there's going to be more. We're going to do $2 or $4 million round. When they raise 10 or 20, a lot of times they look back at the last preferred round and they say, what did they do there? And they take, cues and sometimes even just take the docs. And so if you good set of terms, like in a round like ours, when we think it's fairly friendly and pretty collaborative, that can ripple through the company, the life of the company, for a long time. And so, that is something that we've seen and learned, that if we can help dictate and come up with the terms with the founders, for, the voting agreement, the ROFR, the articles, like kind of how stuff is set up, it's going to benefit us and them in the future. And so that's why we do have definitely a strong, just preference towards a preferred round.
Okay.
So yeah, there you go.
Okay. And I agree wholeheartedly. We have 10 more minutes. I have more questions, but we're getting a number of questions in from the group. Ari, you had a question?
I sure do. Thank you. Just quickly, I imagine this is something you're looking at with the rate of inflation and the economy, and we've just seen the valuation of startups really fluctuate the past couple months. I'm curious how that's going to impact or what you are all looking at and changing your expectations around right now.
Great question. So I think, in 2021, valuations across the board were very high. And we all loved that, if we were already in the market and already in these companies. And so, we took the opportunity to sell like a lot of assets last year. We sold a lot of shares and realized a lot of returns. I think that's true of other companies too, but there are a lot of people that didn't. And so a lot of the later stage stuff, you're seeing it in the news every day, like doing layoffs or kind of down rounds, or like it. I think most of the carnage is yet to happen at the Series B and C stage, but I think those are coming down. Series Seed and A never got too high. I mean, they were definitely high, $10 to $20 million pre for like nothing. Like, hey, I'm thinking about starting a thing. I want a 20 million pre. I think those were kind of crazy last year. Those are going away a little bit, not in all cases. So I think for a founder, if you're starting a brand new thing, I think you're kind of back to where we were in 2018 or 19. And I think that is going to stay. That's my personal opinion. The good news is a lot of capital has been raised at all stages of funds. A lot of people made a lot of money. And so there is a lot of capital out there just sitting on the sidelines waiting. And so there's no shortage of capital out there. I think the bar is a little bit higher to get a round done. And you have to have a little bit more compelling story and maybe a little more traction, but pre-seed, seed, and A can get done all day long. You're going to get a smaller valuation. If you're a Series B, C, D company, even great companies are struggling to get those things done. I mean, you can have grown 3x and you might be looking at a flat round depending on where you raised your last round. So, that's kind of what I see. I'm not going to try to guess like what I know is going to happen with interest rates and the economy, but that's kind of the current state. I think tech has been hit hard. If you look at the NASDAQ, you look at some of these, best in class stuff that was kind of all the rage last year, it's back down. I think a lot of the carnage has happened in tech and it's kind of come back down to earth. The Twitter deal, I'll just use that. I think the Twitter board deserves like just massive kudos for getting that deal done, because it's probably not worth 44 billion. It's probably worth 15 or something like that. Like, I don't know how Elon is ever going to make money, but kudos to him for buying it. But also, man, that board, that was a pretty genius move. They probably won't see 44 billion again for many years. Anyway, I think that's just all to say. I think most of the tech carnage has kind of rippled through the system. Aside from those private rounds that, if you closed a round in December of 2021 and it was just a 30x multiple, you still have cash on the balance sheet, but you haven't had to like justify that valuation yet. And so if that money runs out, that's when you'll start seeing the carnage. So yeah, sorry, I was rambling a lot.
No, that's good. That's good. It's a good question. Thanks, Ari, for asking it. Joy, you have a question? Joy?
Yep. I'm curious, what's your percentage of deal that you actually lead versus follow? And if you follow more, who do you follow?
Yeah, great question. So we lead about probably 80% of the deals, 75, 80% of the deals we do. And that's just what we're set up to do. That's how, we don't really follow that many venture funds. It sometimes is like a pre-seed fund, which are, I guess our venture funds, but, sometimes they blur the lines of angel and venture fund. So we do follow some angel groups, angels, founders who are backing companies. But yeah, we're leading most of the time. The times we're not are generally like, we're not always perfect. We miss companies. Like we see a lot, we can't invest in 90 or 95% of stuff we look at. And once in a while, like we develop a special relationship with a founder and we're like, really love that founder. We missed it. And we're able to get into the Series A. And so we come in as part of that syndicate because it doesn't make sense for us to lead anymore. If we're coming in at the seed, sometimes we'll co-lead, maybe a few times, maybe once per fund we'll be a part of the syndicate of a seed. But yeah, we're really, mostly looking to lead because we're just a low volume shop. So, to do 2 syndicate deals a year where it's just weird for a partner. Like, well, what am I doing? Like, that's pretty simple, pretty easy job. So yeah, there you go.
Yep. Good. Thanks, Joy. Nick, you had a couple of questions.
Yeah. Hey, John, thanks for your time. Sorry, I'm having camera issues. So, but I'm curious just how you've managed conversations with LPs over the last 6 months as the market has been more red than green. So just curious how you've kind of approached that. I don't know if you're raising a fund right now or not, but.
So we were fortunate to close our fund in March. We closed with kind of all our LPs end of March of this year. And so we're not raising capital right now. We did not activate our 4th fund until the summer. And so we're really early in like the new stuff. So there's not really a lot of conversations to manage other than kind of discussing getting their take of the market, kind of getting calibrated on where valuation should be for the new deals. Most of the interesting or maybe harder conversations are happening in our earlier funds, like stuff that we invested in back in 2014, that's grown, or 2016. And so, yeah, we have had to proactively, in some cases, write down companies. If you're familiar with how our financials work and our NAV, we kind of have, we have a valuation policy, and oftentimes you don't have an observable, like, it's not public. So you have the price of the last round, but you kind of have to do valuation work or kind of manage your judgments. And so yeah, I think we've had a number of conversations in the last 6 to 8 months with our LPs about kind of where the market is. And I think we've tried to be really realistic about, stuff that raised last year, where it's sitting today. And yeah, we've written stuff down from, anywhere from 10 to 50%. Some of the weaker stuff that hasn't really performed, we've written off completely, even though they're still, kind of going. And so I think our LPs have just appreciated that kind of transparency, honesty, vulnerability. And so I think if you ask this question again next June, that'll be interesting, because I don't know where the market's going, but yeah, if it keeps going down, we'll probably have to, start making deeper and deeper adjustments. The one thing I will say is our LPs in Fund 1 and Fund 2 are very happy with us because we've already returned, multiples of capital in both funds. Like, we're already not just TVPI, which is kind of your paper gains, like DPI. We have sent back, multiples of capital in Fund 1 and Fund 2, not Fund 3, unfortunately, but so those ones are pretty happy, when you kind of make those decisions, you lose some of the upside, but you kind of bake the returns. They kind of, give you 2 thumbs up for doing that in a high market like we did last year.
All those interim write-downs and write-ups are interesting, but all that really matters is the cash on cash distributions at the end.
Yeah.
Nick Livingston, the other Nick, you also had a question.
Hey, John. I know you were part of Qualtrics, and they had a great success and kind of famous for bootstrapping for so long before having to raise any funding. I was wondering how that might have swayed or influenced your thoughts on what kind of traction or revenue you need a pre-seed or seed to have before you start getting interested.
That's it. Yeah. Qualtrics was an incredible story. I mean, their story started 10 years before their Series A or more. I went through a few iterations before they raised. So I wasn't there for a lot of it, but, I did learn quite a bit from their founder and CEO, Ryan Smith, who now owns the Jazz. He had some really strong opinions on this stuff around kind of nail your model and then scale it, around kind of, be skeptical of VCs. And so I would say, I'm probably like, I don't know if I'm the rare VC, but I do have a little bit in me where I'm like, not every founder should raise venture. Like, venture is a very specific tool and a very specific kind of, service provider that can help certain businesses. And so I think the holy grail is if you just don't have to raise. I mean, honestly, if you've got time and patience and you don't require, if it doesn't require it, don't raise. And so I kind of tell entrepreneurs a lot of times, there's 2 reasons you should raise. If you have a highly technical product, pharma is probably the best example, where you got to go through a deep J curve where you spend $1 billion before, you've got, something good. Great, raise venture, you have to. Or if you have a certain window to a market. So Podium's a good example of this. Not the most technical product, but lots of competitors and a short window of time where, you can become the gorilla in the room. And so I think that's the other time. And so you kind of have to look at yourself in the mirror and ask yourself, like, do I fit in like one of these scenarios where I truly need venture capital? And so, or I think, in Qualtrics case, like they were at a certain stage where it was just like, the capital markets are so strong and offering me so much, like, why would I not raise venture capital? It's almost like coming at me, So I think that's another good time. So, I think it's going to be different for everybody, but I don't think venture capital is the end all be all. So I think that was definitely, kind of been in the back of my head from the Qualtrics days.
Thank you.
Okay, well, thanks, Nick. It's 1 minute after 1 o'clock our time, and I would love to ask more questions, but we want to keep everybody to 1 hour. But really appreciate your joining us today. And you're, I've been around a lot of venture funds over the years. You mentioned Benchmark once. Back in 2000, I served on a board with Bill Gurley, and really share your fondness for that firm. Really like them and Bill. And I really like the way you think. You clearly are kind of have a differentiated way of thinking in your focus, and hopeful that we're able to find maybe another opportunity for you in Spokane. So much appreciate it. Appreciate everyone that also joined us and asked questions. And thank you to Cindy for helping organize this today. And enjoy the rest of your afternoon. And let's find more deals for John to do in Spokane.
Thank you. Thank you for having me.
Thank you.
Thanks, John.
Over and out.
See ya.
Thank you. Excellent. Thanks, Cindy.
That's good. Thank you.
Very well done. Appreciate it.